Okay, real talk. Every time Meta, Microsoft, or Google drops earnings, it's the same headline. Beat expectations again. Stock pops, analysts raise price targets, and your feed fills up with if you're not buying this dip, you're missing out. So you throw a little more in, it's a mega cap. It's safe, right? Except down in the fine print, the stuff almost nobody reads, Wall Street's credit desks are whispering something very different. They're saying some of these beats might be an accounting illusion. And look, this isn't some tiny corner of the market. Meta, Microsoft, and Google alone make up a huge chunk of the S&P 500. So even if you've never bought a single tech stock directly, if you've got a 401k, an index fund, anything tracking the broader market, you already have skin in this game whether you realized it or not. Why does this video actually matter? Because once you get this, you'll never read a big tech earnings headline the same way again. You'll start checking one specific number nobody talks about, and that one number could save your portfolio. I'm Moon. I obsess over where money actually flows and who's really moving it. If you've put money into AI stocks and quietly thought, I hope this is fine, hit subscribe, and if this helps, drop a like. Let's get into it. Here's the common belief. Big tech has tons of cash and barely any debt, so it's bulletproof. Balance sheet looks clean, debt ratio looks low, so safe, right? Here's what gets interesting fast. There's trillions of dollars that never show up on that balance sheet at all. And it's not hidden illegally. It's structured to be legally invisible. Let me show you how. Before we go deeper, here's exactly what to check next earnings season. Two things. One, skip the headline numbers and go straight to the footnotes, specifically lease commitments or future payment obligations. If that number keeps climbing quarter over quarter, pay attention. Two, look for the phrase useful life on equipment. If a company quietly stretched it from 3 years to 5 or 6, that's a company choosing to look more profitable today. Bonus level. Watch the gap between CapEx and depreciation expense. If capital spending is exploding but depreciation on the books barely moves, that gap is deferred pain. The bigger the gap, the bigger the bomb later. Keep those three in your back pocket. Now let's build a mechanism. Picture starting a business with no cash for equipment. Take a bank loan, it shows up as debt. Investors get nervous. But structure it as a long-term lease through a separate legal entity, a special purpose vehicle or SPV. And that spending can avoid showing up as debt on the parent company's books at all. That's exactly the playbook now. Meta financed its massive Hyperion data center in Louisiana through an SPV called Beignet Investor, built with private credit firm Blue Owl, a $30 billion deal, roughly $27 billion of it debt, bought up by PIMCO and BlackRock. Oracle did something similar for the Abilene, Texas facility that houses OpenAI's compute, a $13 billion deal with Blue Owl and JP Morgan, about $10 billion of that debt. Across the industry, more than $120 billion in data center spending has been shifted off big tech balance sheets this way. Think of it like a credit card statement. This month's amount due looks small, but the real number is buried in fine print, total remaining balance. That debt doesn't disappear just because it's off the main page. Someone still has to pay it eventually. A quick accounting refresher. Buy a $1,000 laptop. Expect to use it 1 year. You expense the full $1,000 this year. Expect to use it 5 years. You spread it. $200 a year. Same laptop, wildly different impact on this year's profit, just based on the assumed lifespan. Now here's what Google, Microsoft, and Meta actually did. They quietly stretched the assumed lifespan of AI servers from the old standard of 3 years out to 5 or 6. Let's run real numbers. A $1 billion GPU server cluster on a 3-year schedule costs about $333 million a year in depreciation. Stretch that to 6 years, and it drops to roughly $167 million a year. That's $166 million in extra profit showing up every year. Not from making more money, just from changing the math. Now multiply that across an industry spending hundreds of billions on AI infrastructure. That one accounting choice can move an entire quarter's earnings. So next time you see earnings beat expectations, ask yourself how much of that beat came from actual growth, and how much came from this. Here's another way to think about it. It's like refinancing your mortgage to stretch the term from 15 years to 30. Your monthly payment drops, and on paper your monthly budget looks a lot healthier, but you didn't actually save any money. You just push the same total cost further into the future, and usually paid more in the long run because of it. That's basically what stretching useful life does to a company's income statement. It doesn't create value, it just moves the expense down the road. And here's the part that should really make you raise an eyebrow. Executive bonuses and stock compensation at a lot of these companies are directly tied to reported earnings per share. So the same accounting choice that makes the company look healthier also happens to make leadership's paycheck bigger. That doesn't mean it's fraud. Depreciation schedules are a judgment call and auditors sign off on them, but it does mean the incentive to lean generous on that judgment call is baked right in. Here's where it gets serious. Nvidia isn't slowing down. Blackwell just shipped. And Rubin is already the next headline, roughly annual generational leaps. Real-world GPUs run under constant heat and voltage stress in data centers and become outdated or lose efficiency within a year or two. So the books say we'll use this for 6 years. Reality says 1 to 2. That's a 4 to 5 year gap between assumed and actual lifespan, and gaps like that eventually have to close. It's the credit card minimum payment trap, scaled up. Pay the minimum, feel fine, until the day the full balance comes due at once. For these companies, that day comes if AI revenue underdelivers or data center utilization drops. The deferred depreciation and lease liabilities they've been quietly pushing forward can hit the books all at once, a one-off shock that shows up as an earnings cliff. Now, I know what some of you are thinking. Wait a second, Moon. Accountants and auditors sign off on all of this. Rating agencies review it. Wall Street analysts pore over these filings every single quarter. Isn't this already priced into the stock? Here's the honest answer. Partly, yes. The SPV debt and the useful life numbers are technically public. They're sitting right there in the footnotes and the 10K filings for anyone to read. But here's the catch. Most retail investors never open a 10K. Most people are trading off the headline number and the stock chart, not page 90 of a footnote section. And even among professional analysts, the assumption baked into most models is that AI demand keeps growing fast enough to make the accounting math work out fine. That assumption hasn't really been tested yet, not at this scale, with this much debt, moving this fast. So no, this isn't some secret nobody knows about. It's more like a risk hiding in plain sight, priced for a best-case scenario that assumes nothing goes wrong. So here's who actually gets hit first, and it's probably not who you'd guess. Not Nvidia. Step 1. The neoclouds. Companies like CoreWeave, which pioneered using raw GPS as loan collateral. Analysts are already calling this the GPU maturity wall. The collateral loses value faster than the debt gets paid down, with covenant breaches possible as early as 2027 if chip values fall faster than assumed. Step 2. The private credit funds and insurers who actually hold that debt. Blue Owl, PIMCO, BlackRock, JP Morgan, the firms behind Meta's Hyperion deal and Oracle's Abilene deal. If Step 1 cracks, they absorb it first. Step 3. The securitization market. Data center debt increasingly packaged and sold like mortgage bonds, a market projected to hit $30 to $40 billion a year by 2026 to 2027. The bigger that market grows, the wider the blast radius if something breaks. Step 4. Only then does it hit the household names. Meta, Oracle, Microsoft, stock itself. And this isn't hypothetical anymore. Oracle bondholders already filed suit in early 2026 over losses tied to its AI buildout. The first crack in this domino may already be moving. And that matters even if you don't own a single share of Oracle or CoreWeave directly, because problems in credit markets don't stay contained. When private credit funds and insurers take losses, they pull back lending everywhere. And that tightening ripples through borrowing costs across the whole market, including whatever you're holding. If you're holding big tech stock, make this a habit every earnings season. Check the lease footnotes, check the useful life assumptions, check the CapEx to depreciation gap. The investors who actually read past the headline are the ones who see it coming. Protect and grow what you've built, subscribe, and I'll see you in the next one.